Hi, this is Kerry Artak with Artak Advisory. This is the AgriTalk weekly AgriTalk video supplement for Monday's show, Monday, June 14th. In it, I will be covering or will cover three markets as usual. This week it'll be July corn, July soybeans, and August feeder cattle. This is all big picture stuff. Primarily what I'm showing you are weekly continuation charts that are based on volume, rollover. That's kind of important. It's a slight difference between traditional rollover. Volume-based rollover means exactly as it sounds. That, for instance, with regard to July corn, when the September contract exceeds July volume, September will roll to those contracts. It doesn't necessarily wait all the way to the very last day for July to expire. It rolls a little earlier than your traditional chart. It sort of follows the money, if you will. Before I jump into these charts, I just would love it if you haven't had a free trial yet, or if you've not had a free trial in the last 6 months, please take me up on my 2-week free trial offer. You can fill out the free trial form. It's all over the place in terms of my website, the free trial link, first name, last name, a phone number, email address, certainly, and then you'll receive everything that I put out on a daily basis for 2 uninterrupted weeks. I'll give you a call during that time. We can talk the markets, talk about what what your trading or hedging needs are, your strategies. You could pick my brain if you want. Obviously my end game is that you become a regular monthly subscriber. But that's not necessary. You can do the 2-week free trial. No credit card needed, no information other than your name and email address, and ideally a phone number so we can talk on the phone. Anyway, let's jump to corn, Chicago Board of Trade corn. This is the weekly continuation chart based on volume rollover. It presently reflects the July contract. When September exceeds July volume, September will inherit these price points. These are the stringing together of old contracts, which is about the only way you can really analyze the futures market long term with regard to weekly and monthly charts going back many years. Anyway, I can backtrack a bit and tell you that last December we had a significant buy signal above the 464 3/4 channel top. At that point, I was anticipating the upper 640s. We took that out, and I'm not even showing that. But right now, we are in a secondary buy mode longer term, still maintaining a 3 to 5 month upside objective at 834 1/4. This will remain intact so long as this market continues trading at or above this rising 1/3 speed line this week at 624 3/4. So if tested, 624 3/4 can absorb selling through July, through summer trade, and from here we can push onward to new highs over the coming months. I still think 3 to 5 months is realistic for 834 1/4, by which point the December contract may well be on this chart. And so December has another 70 or 80 cents to go to the upside before it actually catches up, if you will, with the July 21 contract. If we close below 624 3/4 at the end of any week, and this speed line is rising, then we have an indication of a good annual high. And I would then expect the broader corn market to give much back of what was gained from the December rally on, whereby 464 3/4 becomes a 3 to 5 month target. So closing below 624 3/4, I'm expecting 464 3/4 within 3 to 5 months, where this long-term channel top can absorb selling through next year. And once again, if we happen to test 834 1/4 over the coming months, and that remains a target above 624 3/4, this 834 1/4 channel top able to contain buying through next year. Let's take a look at, this is more of a close-up of that speed line at 624 3/4. And this is the December contract. A different contract, obviously. Old versus new crop. This is new crop. The December contract is also bullish. above 557 and 3/4, anticipating 676 even by the end of July or sooner, and quite possibly that 834 and a quarter mark as we continue into autumn trade that I showed on the previous chart, which is a weekly continuation chart. So December 21 remains bullish above 558 and 3/4, expecting 676 even by the end of July, where this contract can top out on a monthly basis. And if we close above 676 even, then that 834 and a quarter level looks to be more of a 2 to 3 month reality. And once again, able to contain broader market corn futures buying pressures through next year. Now, downside, even if we break 558 and 3/4 this week, we have 550 even, which is not illustrated, but I can tell you if you back up a little bit on this video and you look at that speed line at 624 and 3/4 on the weekly chart, that's on the July is actually on that chart right now. 624 and 3/4 July contract is essentially 550 even December contract. So with regard to DEES 21, bullish above 558 and 3/4, anticipating new highs in the coming weeks, and then we turn bearish below 550. In other words, below 624 and 3/4 July contract. And if we do happen to close below 550 at the end of this week, then this market should fall all the way back into the 460s again, 464 and 3/4 within several months. Let's move on to soybeans, July soybeans. We had a buy signal in November above this structure, presently at 1131 and a quarter. 1654 and a quarter was the long-term objective that we actually met in early May. So we tested this channel top. Now that we've tested this channel top, this market can fall back into the 1130s perhaps over the next 6 to 9 months. Now on the way down, we have trend-defining midterm support at 1403.5. And what I'm telling subscribers is we can bounce off of 1403.5 and rally back to 1654 and a quarter and fill this wedge out all the way through summer trade. But the more significant of these two levels is 1654 and a quarter, and I'm not surprised if at the end of some week coming up over the next 3 to 5 weeks, I'm not surprised if we happen to close below 1403.5, which is a speed line that's rising weekly. And if we close below 1403.5 at the end of this week, for instance, and it rises gradually, then we have an indication of a good annual high. The next 3 to 5 months then expected to continue south to 1131 and a quarter, where the broader soybean market can bottom out through next year. So the way I'm framing this, long-term heavy below 1654 and a quarter, and you should allow for 1131 and a quarter, perhaps by the end of the year. Midterm, however, we're in a two-sided framework between 1654 and a quarter ceiling and 1403.5 floor, and we could trade inside this wedge through summer, but closing below 1403.5 is the likelier outcome, likelier than closing above 1654 and a quarter, and closing below 1403.5, 1131 and a quarter becomes a 3 to 5 month objective. Now, upside, if we happen to close the week above 1654 and a quarter, then we have another 3 to 5 month buy signal. May take longer, but in any event, I would anticipate 1982 even as our next long-term target if we closed above the mid 1650s. This is a monthly chart. What I showed you before was a weekly chart. So this takes into account 30 years of trade. And if we happen to close at the end of any week above 1655 and 3/4, 1982 even becomes a 3 to 5 month objective where the broader soybean market can top out not only through next year, but quite possibly the decade itself. Finally, August feeder cattle is the front month on the weekly charts. We've been testing this long-term channel top now really since April. When we had the May and now August contracts have tested it many times, half a dozen times anyway. 153.87 is our ceiling through the year, and from here the market can fall back to not only 142 and a quarter, but even into the low 120s again by the end of the year. We can trade inside this wedge, 142 and a quarter to 153.87 over the next few months. The 142 and a quarter level is less significant than 153.87. In other words, it is more susceptible to violation. And if we were to close below 142.25, that would be our indication of a good high through summer. The next several months then expected to yield 122.5, where the broader feeder cattle market can bottom out through the rest of the year. Inversely, if we close the week above 153.87, and I need to see that by at least a 1% violation threshold. In other words, if we close Friday, the week itself, at 155.32 or higher August contract, then we actually have a long-term buy signal, where over the next year or two, we could actually reach into the 220s. But for all intents and purposes, along the way, I would anticipate 179.42 as a 3 to 5 month objective. So if we close this week above 153.82 by the 1% margin I mentioned a moment ago, then we have a buy signal into later year, 179.42, then anticipated within 3 to 5 months, where we can top out through the balance of the year. But I'll finish with this. If we close the week above 153.82 by the 1% violation, you should allow for 224.75 by the end of next year, perhaps, where we can top out on a decade-long basis. And I do believe that that's all that needs to be said for this week's AgriTalk video supplement for Monday, June 14th.
So do yourself a favor. Fill out the free trial form on this website. Take that 2-week test drive. You've nothing to lose and much to gain.